Welcome to this deep dive. Today, we're digging into the recent Q3 fiscal 2025 earnings conference call for LightPath Technologies material you sent over.
Yeah, our mission is really to unpack the key results, the strategic shifts, and what they're saying about the future.
We'll hit the important numbers, look at how their business model is changing, delve into some pretty significant growth opportunities, and check out how they're handling the whole global supply chain situation.
Think of it like getting behind the press release. We're looking at the actual call, the Q&A. That's where you often find the really interesting stuff. Understand the story management's telling.
Okay, let's jump right in then. The Q3 snapshot. This is for the quarter ending March 31st, 2025.
Right. So top line, revenue saw a pretty notable increase. It was up 19.1% compared to last year.
Came in at $9.2 million. That's not insignificant.
No, definitely not. And interestingly, that increase flowed down pretty strongly to gross profit. That climbed 66% to $2.7 million.
And the gross margin percentage, that saw a big improvement too.
Huge. Went from just under 21%, 20.9% a year ago, up to 29.1% this quarter. That margin expansion really tells you something's changing in what they're selling.
It does, but while that didn't translate directly to the bottom line this time around, operating expenses were up quite a bit.
Yeah, up 44% to $6 million. They laid out a few reasons for that.
Like M&A costs, right? Legal consulting fees, specifically for the G5 acquisition.
Exactly. Plus more product development spending, G5's own operating costs being included now, higher amortization, and more sales and marketing push.
So all that meant a net loss for the quarter of $3.6 million, which is wider than the $2.6 million loss they had a year ago.
Right. And the EBITDA loss followed suit. $2 million loss this quarter versus $1.5 million previously. So you see better profitability per dollar revenue with that gross margin jump, but the investments and the G5 integration costs are definitely weighing on the short-term results.
Okay, balance sheet check. Cash looked better, right?
Yeah, cash and equivalents improved. $6.5 million at the end of March, up from $3.5 million last June. Debt stood at $5.5 million.
And the backlog. That gives you a sense of future business.
Still strong, $27.4 million. That's a good indicator of booked orders they expect to fulfill.
So beyond those numbers, what was the kind of big picture message?
The big message was really about this major strategic transformation they're in the middle of.
They emphasized that just a few years back, they were mostly just an optical component maker, focused on precision glass molding.
Exactly. And that market, well, it became commoditized. Tougher to make good margins there.
So the strategy starting around late 2020 was to move up the food chain, basically.
Right. Leverage that core optics expertise, but become a solutions and subsystem provider. It wasn't an overnight thing.
Started with optical assemblies, then compact thermal cameras.
And then acquisitions really accelerated it. Visimid brought in things like video engines, camera cores, optical gas imaging.
And most recently, G5 added cooled infrared cameras, the high-performance stuff for long range.
Yeah. So the result is you look at the business mix now, and things like assemblies, cooled and uncooled cameras, other subsystems, stuff that was a small part before.
Now it's about half the revenue, with components making up the other half.
Roughly, yeah. And management expects that non-component piece to keep growing because the average selling prices, the ASPs for these more complex systems are just naturally higher.
So higher value, bigger projects, more potential upside.
That's the idea. It allows them to go after these larger, potentially, game-changing programs.
Which sounds like a good transition to those growth drivers.
Right.
They talked about several big potential projects.
They did, across the whole range, materials, assemblies, cameras. They actually said the number of these big potential deals has increased, so they couldn't go into exhaustive detail on every single one.
Well, defense stuff often has limits on what they can say publicly.
Right. But they did highlight a few key ones. The NGSRI program with Lockheed Martin, that's the Stinger missile replacement.
That's run by the Visimid group they acquired.
Yes. And they called it their largest single revenue opportunity. It's moving along as planned, but it is a competitive bid against Raytheon, so they're careful about sharing details.
Okay, what about from the G5 acquisition? The group in New Hampshire.
A main one there is the SPEAR program with L3 Harris. They're providing advanced infrared cameras for Navy ships.
For spotting threats like drones and unmanned boats, CUAS.
Exactly. Passive threat detection. And the key thing from the Q&A here was confirmation. This is an awarded sole source program of record. It's moving towards production.
Awarded and sole source. Okay, that means they want it, and they're the only supplier. That's significant.
Very. G5 also has other big programs in border security and more CUAS applications.
The border security one, that was an IDIQ, right? Indefinite delivery, indefinite quantity.
Correct, which means there's some year-to-year uncertainty on volume. But within that IDIQ structure, G5 is the sole provider to one of the prime vendors, Elbit, whose system seems to be the one getting deployed most.
So even with the IDIQ structure, it sounds pretty promising. They've got initial orders.
Yes, initial orders received. Significant delivery is expected soon. Management's talking about these G5 projects potentially bringing in, say, $5 million to maybe even $20 million in revenue each per year.
Wow. Okay, besides cameras, they mentioned programs using their own material. Black diamond glass?
Yes, 2 large ones based on black diamond, which they license exclusively from the U.S. Naval Research Lab, the NRL.
The Apache program was one, right? We've heard about that before. Sounds like it hit some snags.
It did, some delays, and credit to them, in the Q&A, management owned those delays, said it was on their side, challenges balancing capacity, some issues working with the new BDNL-8 material variant.
So like internal manufacturing hurdles.
Basically, yeah. Required rescheduling some glass builds, but they framed it as temporary, solvable, not something that jeopardizes the overall Apache opportunity.
Okay, understandable. And there was a newer Black Diamond program.
Yeah, also using the NRL licensed materials, and this one sounds like it's moving incredibly fast.
Fast how?
The government is actually putting up significant money for equipment to speed things up. It involves redesigning an existing system, and apparently the performance is just exponentially better with Black Diamond.
So the material itself is enabling a big leap.
Seems like it. And they expect this one to also hit that multi-million-dollar order level soon, potentially $10 million or more a year once it hits production, maybe in 1 to 1.5 years.
Okay, having multiple shots at programs worth over $10 million a year each, for a company this size, you can see why they use the word transformative.
Absolutely. And that black diamond material is clearly a key part of the story. It's an infrared material made in the USA.
And a big advantage right now is it's an alternative to germanium and gallium.
Exactly. Materials heavily reliant on China, which, as you know, has restricted exports recently. That's a huge deal for defense customers looking for secure supply chains.
But it's not just about supply security, right? There are technical benefits.
Definitely. They talked about how using black diamond, the different types like BDNL4, BDNL8, BD6 can often lead to smaller, lighter systems that actually perform better overall.
And demand is growing. They mentioned adding capacity.
Demand is strong, yeah, especially for the BDNL types. They are adding manufacturing capacity, and significantly, that expansion is getting financial backing from the Department of Defense.
DoD funding, that's a strong signal.
It really is. Management sees it as proof that their bet on Black Diamond is paying off, that it's creating the differentiator they hoped for, especially with the DoD's focus on domestic critical materials.
And this seems to be driving orders. They mentioned a big booking number recently.
Over $19 million in new orders booked in the 90 days before the call. Not all of that hit the official backlog number for Q3 because the G5 deal closed mid-quarter, but it shows real momentum, particularly around Black Diamond adoption.
Okay, let's shift gears a bit. How are they navigating all the, global economic and geopolitical stuff?
Yeah.
Measuring footprint, tariffs.
They spent some time on that. It's been a deliberate multi-year shift. 5 years ago, most manufacturing was in China. Now, it's heavily weighted to the U.S., 45% of headcount, 56% of footprint, and Europe. China is less than 10% of revenue now.
So that drastically reduces their exposure to, say, U.S.-China tariffs or a slowdown in China.
Much less direct exposure, yes. They said they managed to sidestep most direct impacts from the April tariffs through quick internal supply chain moves.
How?
A key strategy, really built up since COVID, is having redundancy. They can make almost everything in at least 2 different locations, except the specialized glass in Orlando, so they can shift production between countries if needed.
That flexibility sounds crucial. What about the risks from customers who still depend on China?
That's a real consideration. Their take was interesting. It depends on the tariff level. When tariffs were super high, like 145%, customers were willing to pay a premium for U.S. or European manufacturing.
But if tariffs drop way down, say to 10%.
Then it becomes a question mark. Would customers still pay that premium just for resilience? So LightPath is focused on optimizing their own chains, building alternatives, and having those conversations with customers, arguing for the value of paying a bit more for long-term supply security. And they find customers are more receptive now after all the recent disruptions.
Makes sense. What about germanium supply? The China restrictions help LightPath now by pushing customers to Black Diamond.
Right. The obvious worry is, what if China opens the taps again and germanium becomes easy to get?
What's their answer?
Two parts. First, they argue black diamond often has technical advantages beyond just availability. Once a system is redesigned for black diamond, it often performs better, so customers have a reason to stick with it. They're trying to accelerate those redesigns.
And the second part?
Second, they just don't see China loosening those restrictions. If anything, they expect them to tighten further. So the germanium supply constraint looks likely to continue, in their view.
Okay, let's circle back quickly to the Q3 financials, the revenue mix.
Right, that $9.2 million broke down like this. Infrared components were 40%, about $3.06. Visible components were 31%, $2.08. Then assemblies and modules were 20%, $1.09. And engineering services made up the last 9%, so those 8 cents.
And that mix shift with more assemblies, modules, services, that explains the gross margin improvement we talked about earlier.
Exactly. It shows that strategy of moving up the value chain is actually impacting the numbers now.
How about the G5 integration? That closed mid-quarter, right? February 18th.
Yep. They said it's going well. Highlighted a good cultural fit, which is always a positive sign in M&A. They're integrating where it makes sense, not forcing everything together immediately.
And the outlook for G5's contribution?
The combined company target is $51 million in revenue for the 12 months, starting from that Feb 18th close date. G5 itself booked $13 million in new orders just since the deal closed.
When will those orders ship?
Mostly between June and December this year, so you'll start seeing more G5 impact in the current quarter, Q4, but it'll really become significant in Q1 and Q2 of the next fiscal year.
The CFO had a warning about net income, though, right? For the next couple of quarters.
Yeah, basically said expect net income to look messy due to complex accounting around the G5 financing warrants, convertible preferred shares, that kind of thing.
So focus more on EBITDA.
Exactly. Recommended focusing on EBITDA and adjusted EBITDA for a clearer view of the core operational performance, filtering out that accounting noise.
And strategically, G5 is seen as a good move.
Very much so. Described as valuable, well-run, profitable, growing, strategic, good culture fit, all the positives. The term they used was it should supercharge their near-term potential, especially in defense.
Adds higher margin products, helps them get towards that 15% EBITDA margin goal faster.
That's the plan.
Okay, Q&A time. What about the outlook for this quarter, Q4 ending in June, specifically EBITDA?
They adjusted that slightly. Previously thought it might be break-even or positive. Now they expect it to be close to break-even.
Why the change? Lower demand.
No, not demand, just timing. Some larger, more expensive systems are shipping later in June than initially planned, pushes the revenue recognition out slightly.
Got it. Did capacity at G5 come up? Can they handle these big orders?
Yeah, they think assembly capacity is okay, can add shifts. The main constraint is component supply, especially detectors. They have large orders out for those and optics, though LightPath's own optics capabilities might help there eventually.
And sales integration. They had a VP of sales leave unexpectedly.
They addressed it, said integration is happening, the existing LightPath team is working with G5's people, the CEO is personally involved too. And interestingly, the LightPath name is apparently helping G5 open some new doors.
What about the G5 earnout? Are they on track?
There are revenue and margin targets. First period needs $21 million revenue and a 20% standalone gross margin for G5. Based on shipments, pre-acquisition plus bookings and visibility for Q4, they have about $19 million towards that $21 million revenue target.
So revenue looks on track.
Seems like it. Margin data is still early, but they said no red flags, and the earnout itself is obviously a big motivator for the G5 team.
Okay, so summing this all up, it really sounds like a company deep in a strategic pivot.
Definitely. Moving deliberately away from commoditized components towards these higher value systems and solutions. It's a very conscious shift.
And acquisitions like G5, plus their unique black diamond material, are clearly the engines driving that shift.
Absolutely. Opening doors to much larger programs, especially in defense, where that domestic supply and high performance really matters.
They also seem to be actively managing the global risks, the manufacturing redundancy, the focus on materials less dependent on China.
Yeah, building resilience seems key to their strategy now. It's not just about cost anymore.
And it feels like there's real momentum building looking at those strong booking numbers, even if the reported financials are a bit noisy right now with integration costs and timing.
The focus seems clearly on setting up for longer-term growth and better profitability.
Okay, thinking about all this. The strategy, the black diamond advantage, the supply chain discussion, here's something to mull over.
Right.
They noted customers paid a big premium for resilience when tariffs were sky high, but questioned if they'd pay that same premium if tariffs dropped low. What does that tell you about how much long-term value customers really place on supply chain security once a crisis fades?
That's a great question. Is that willingness to pay for resilience a permanent shift, baked in now because of recent shocks? Or is it more tactical, something that fades when the immediate threat perception drops?
Does a unique material like black diamond, with its technical and supply chain benefits, lock in that premium regardless? Or does cost eventually become king again if, say, germanium somehow became readily available?
It really makes you think about the durability of these strategic shifts driven by geopolitical risk versus pure market economics. How sticky is that resilience premium?
Definitely something to chew on. And just a reminder for everyone listening, this discussion and that thought starter are based on the earnings call information. It is absolutely not financial advice.
Please, always do your own research, consult with professionals. We're here to unpack the information, not give recommendations.
We hope this deep dive was useful for you. Thanks for tuning in.
Yeah, thanks for joining us.